The reason for today's hike is threefold. We see economic recovery to continue. Consumer price inflation is also seen to increase, and the risk of a buildup of financial imbalances.
I don't think Jay Powell wants to upset the apple cart. I really don't think he's going to try to push people in one direction or another.
At the end of the day, there's got to be good, remunerative job opportunities for middle-class and lower-income Americans paying rising wages. And that's what we have.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 26th of August. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Watching Wyoming, investor attention turns to the Fed's Jackson Hole meeting for any clues on tapering. Stocks waver, Treasury yields hold to a gain. France's road to recovery just 8 months away from the presidential elections. Executives and politicians gather in Paris. We're live from Medef with the French Trade Minister. And Britain's biggest business group warns that consumer firms are turning pessimistic as they struggle to find staff after lockdown. We'll discuss with HSBC's global chief economist, Janet Henry. Now let's go straight to the markets. Investors approaching the Fed gathering in Jackson Hole with caution. European equities trading a little bit mixed. U.S. futures actually threatened to snap a 5-day winning streak that has seen the S&P 500 hit another record. Now, with all of your market action, here's Ritika Gupta. Hi, Ritika.
Hi, Francine. We see markets very much in wait-and-see mode ahead of that Jackson Hole symposium. But, of course, we do have this quite slight risk-averse tone here. The Stock 600 down some 0.2%. Pretty much flat over in the U.S. if we look at futures. It's not surprising, really, that market participants dial back a bit of that risk ahead of big events like this. But again, we know we're trading around record highs. Another one reached yesterday over in the U.S. We haven't seen a pullback of 5% or more in about 10 months or so. Then we look at the yield space. We did see a lot of action there. Yields rising to 1.34% ahead of Jackson Hole. And the dollar, we've seen continued strength, and there's going to be a lot of focus in that post-Jackson Hole. It could move a number of scenarios here if Powell, for instance, talks about the risk of the Delta variant, maybe that drives the dollar higher, demand for that safe haven asset. Or if he talks about the strength of the economy, perhaps we see the opposite effect. So a lot of eyes on those risk assets post-Jackson Hole, Francine.
Ritika, we also heard from the Bank of Korea. Was it a warning shot?
Yeah, Francine, well, we may very well see more rate hikes down the pipeline. That's after we got that 25 basis point hike to 0.75% there. Now, the Bank of Korea faced a stark decision here. Do they focus on rising debt, rising household debt, rising house prices, or do they focus on the spread of the Delta variant? Well, back Governor Lee focusing on the former. He says the financial risks seem to be outweighing those of the virus now for the economy. You kind of see that when you look at this chart here. This is your inflation expectations, and the Bank of Korea lifting those to 2.1% by year. And that is that green line sitting way above that, what the market thinks, about 1.9% here. So very interesting to see this Asian central bank doing a different move to what we're seeing some of the other developed economies who seem to want to keep it lower for longer, Francine.
Ritika, thanks so much. Ritika Gupta there with some of your markets. Now, joining us to talk everything markets is Eddie van der Veld from the M-Live team. Eddie, I love getting you on a difficult day because there's not actually that much action going on in the markets. So I love putting you on the spot. I mean, if you look at bank, I mean, do you look at, we look at Jackson Hole. I don't know how much we'll actually get from Jackson Hole. Yeah. But it's a funny day because there's just a bit of a lack of anything.
Yeah, you say that. I'm quite excited today. I'll tell you what, there's not a lot of action out there, but there's a lot of anticipation. Yes. And for good reason too. There are people that in financial markets, we tend to look at these big events and the default response is it's going to be a damp squib. It's not, nothing's going to happen. But this time, there's real two-way bets here. Yeah. There are people that are saying, listen, the Delta variant is spreading so fast, even the Fed had to move this thing online. They are going to step back and they're not going to taper as quickly. And there are others that say, listen, inflation is really picking up. We are going to see that. We are going to see that taper, and then we're going to see an impact across equity markets and across. And I think it was really interesting last week when we had that sort of mini taper tantrum preview. Yeah. I think it was last Thursday, when market just showed us how this would play out if we do see that taper this year, whether it is played out in equities and it is played out in commodities, much more so than the previous taper tantrum.
But, so, Eddie, and I love actually the way you put it in position, and this is exactly what traders are trying to figure out. I mean, how much more dovish could Jay Powell be tomorrow?
Yeah, I think there's a balance for him to strike, right? I think because if he's planning on tapering this year, he needs to communicate that now. If he doesn't communicate that now, the market is going to be caught offside later in the year, and that is not something that they want. So I think he wants to be very clear on his messaging. Maybe he leaves himself a little bit of wiggle room if he doesn't plan on tapering. But I think that remains to be seen.
I mean, why is there such big difference, with what the market or the bonds are pricing in and actually what equities are pricing in?
Yeah, I think because I think it's difficult. So the Michael Burry trade earlier this week, where we saw, he's being short both bonds and long bonds and equities. I think a lot of people think that this is how it's going to play out, where if we see a taper, we see yields climbing, and therefore we see equities coming down. But the money's got to go somewhere, right? The money's got to go somewhere, and I think that supports bonds a little bit. So I think we see less volatility in bond than we did in the last taper tantrum, but we see a lot more in equities and in commodities if this plays out as a taper.
Eddie, thank you so much. I mean, Eddie even makes a quiet day exciting, talking about anticipation. I mean, it is Jackson Hole week, so we'll give you that. Eddie van der Walt there from our MLive team. Now, coming up, France overtakes the UK to become Europe's most vaccinated large country. What does that mean for its recovery? We'll talk about all of that with the French Trade Minister live from the MIDEF Business Conference. And then a little bit later, we'll also speak to the Hsbc Global Chief Economist. She's Janet Henry. We'll talk Jackson Hole, China's tech crackdown, and the UK labour shortage. Now, if you have any questions for either of them, please write IB plus TV Go, or you can always tweet me directly at Lacqua. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's go straight to the Bloomberg First Word News with Laura Wright. Hi, Laura.
Hi, Francine. The U.S. has warned against traveling to the airport in Kabul due to security threats, as the administration says it knows of around 1,500 Americans who are still in Afghanistan. Secretary of State Antony Blinken told reporters the U.S. is relentlessly trying to reach them, but does not believe all of them wish to leave the country.
It's hard to overstate the complexity and the danger of this effort. We're operating in a hostile environment in a city and country now controlled by the Taliban, with the very real possibility of an ISIS-K attack.
A shortage of workers to fill jobs in the UK has seen a big drop in business confidence in the services sector. A quarterly survey by the CBI, the nation's biggest business group, showed optimism at minus 17% this month, down from a reading of plus 47% in May. Firms citing labour shortages are at their highest level since the survey started back in 1993. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Laura. Now, just 8 months away from the French presidential election, and executives and politicians gather in Paris today for the conference organized by the country's biggest business lobby, MIDEF. Today, the three main concerns from French executives and the government are the spread of the Delta variant, hiring difficulties, and of course, supply chain disruptions. So how does France plan to tackle these potential bumps in the road to recovery? Well, let's get to our reporter on the ground, Caroline Conan, who's at MIDEF with a very special guest. Caroline, good morning.
Good morning, Francine. It's back to school for business executives in France and politicians, and I'm very happy to be joined by the Trade Minister Franck Riester from the MIDEF conference in Paris. Good morning.
Good morning.
Tourism industry was one industry especially hit by this crisis. Today we could have new travel restrictions at the EU level on the US citizens. How bad is this going to impact the tourism industry in France?
We are going to see exactly what kind of decision could be made around the transportation to the US. But you know that the summer was quite good for tourism in France, thanks to French tourists, European tourists, but also tourists from all over the world, and specifically the US. We need American tourists for our economy, and we need that American citizens could come to Europe, to France, for business as well. So we are looking very carefully about how we could deal with the restriction, with the health situation, but also to facilitate circulation between the US and Europe.
The relationship with the US is actually improving when it comes to trade. For example, wine exports have rebounded strongly since trade tensions with the US have calmed down. Can the Afghanistan crisis change this?
No, I don't think so, because we'll see the consequences in terms of security due to the situation in Afghanistan. But in terms of relationship between the US and Europe and France specifically, I think things are going better and better in the commercial point of view. You talked about the Airbus dispute, and we succeeded in creating a specific momentum to put the tariff off for over 5 years, and the consequences on wine and aeronautics are already good. And so we think the trend is good to renew the relationship between the US and Europe. We will have much work in the future, because there are still many files, many topics that are remaining problematic for Europe. I could quote all around steel, all around extraterritorial use of the American law of the dollar against our companies. But the way we are working with our partners from the US is getting better and better.
Are we actually close to a deal on aluminum tariffs?
I'm not sure that we could say that we are close, but we are working on. And it's a good news, because in the past we didn't work very concretely on that. That's not the case anymore. And so I am optimistic, but concentrated.
Do you think that could come by the end of the year?
Yes, perhaps. We hope that, because we have some important agenda on that. And we hope that thanks to the discussion in the G20, in the WTO, we will tackle important issues as overcapacities of steel from Asia specifically. We agree with the states on this specific problem, on an unfair competition in steel sector. And the way we are working with the states in this sector is really a good way, I think.
In the first half of the year, trade deficit in France widened to 34.7 billion euros. What's the outlook in terms of the trade rebound for this year and for 2022?
For this year, we observe that our companies are coming back to the exportation. I should say that they are even more involved in exportation, because we have 132,000 companies that are exporting in 2021. It's the figure the more important ever noticed in France since 20 years. So it means that companies are bouncing back to the exportations. The level of our exportation is almost the same as now before the crisis. In the first semester of 2021, it's good news, and in some specific sectors we are even ahead. I could say agro-food, I could say pharmaceutical, I could say even health sector. So we think that we are really in the good direction, but still we have some sector as aircraft manufacturing that are very far from the level where they were before the crisis.
What's the biggest threat to this rebound? Is it supply chain disruptions or labor shortages?
Labor shortages, the fact that we do not have enough entrants for our industry, due to the big rebound of the world economy. And so we need to rethink some of our value chains, some of our supply chains, so that this recovery could be resilient in the future. That's what we are doing in France. That's what we are doing in Europe. And it's the art of our recovery plan, as announced by the President Macron and Bruno Le Maire, our Minister of Economy.
Franck Riester joining us from the MEDEF annual conference, the French Trade Minister live from Paris. Francine?
Caroline, thank you so much. Caroline Conan there in Paris with, of course, that minister talking about a number of issues and a number, of course, of things that France needs to deal with or try and deal with before the presidential election, April 2022. Now, coming up, the future of work as we emerge from the pandemic, companies look at the economic benefits of hybrid working for their employees. That story is up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, there's no doubt that COVID has changed the way we work. With each enforced lockdown, many people moved to working remotely from home. Now, as we emerge from the pandemic, businesses are looking at the economic benefits of hybrid working for their employees. Well, Bloomberg's Libby Cherry joins us now. Libby, you wrote this fantastic piece, which is actually our big take today, our big read, which I urge everyone to go and read it. So companies are now trying to entice workers back into the office. What would an economist say to an employee or an employer or a manager desperate to get their staff back?
Well, I think they would say, don't rush to get your workers in 5 days a week. One of the studies that we looked at showed there could be a 5% increase in productivity relative to pre-pandemic levels just from having the shift to hybrid working. So a lot of that comes down to save commuting time, but there's other things as well. So a lot of employees reported that they were more productive at home for more focused tasks. And another thing I would note, if you're an employer, is that you might have access to wider pools of employees if you offer this flexibility. I'm thinking working mothers, people who live outside of economic centres, and potentially older workers as well.
I mean, this was one of the concerns, like when people work from home, you don't have time for chit chat, right? So you don't find yourself at like the Kool-Aid moment, or you kind of have that interaction a little bit less, which I know a lot of people also miss. How does this change actually working habits, and how does that, reshape our economy?
Well, of course, yeah. So we're already seeing some of the impacts kind of in the wider economy. I mean, just look outside at the city centre. We're seeing sort of lower levels of footfall. Have a look at the Bloomberg Pret Index, for instance. It's well below pre-pandemic levels of coffee sales. But those spending patterns are shifting to the suburbs. And we're also seeing a whole ecosystem of innovation that's come out of hybrid working, whether that be like shops that have adopted e-commerce for the first time, and they're tapping into new customers. They're no longer reliant on people just walking past their shop fronts. I mean, to be sure, there will be some economic pain coming out of this. And I think a lot of companies in city centres at the moment are kind of in a wait and see kind of moment for what it will be like when people come back from their holidays.
So if you see, what does the boost in productivity, why is it such a big deal for the economy? I mean, this was like the puzzle, right? Is like, what is it, like 5 years we've been talking about productivity and why it's been so low?
Yeah, well, this is the thing. So, I mean, if we're just looking at the UK, for instance, in 2019, we were lagging our pre-financial crisis trend for productivity by around 15%. So it wasn't great even before the pandemic. And COVID has been this catalyst, We've never seen anything like it, companies being forced to innovate and so on. So while hybrid working in itself might not fix all our productivity problems, I think a lot of economists will be watching it closely for the kind of efficiency gains as we begin to come out of the pandemic.
I mean, it's an amazing, I mean, how much does it increase productivity? So if you work from home, do you actually have the data of, am I like 12% more productive on a good day or 5% more productive?
Well, I think a lot of it comes down to the task. But if we just look at the proportion, the vast majority of, workers who are in sort of knowledge-based jobs are definitely thinking about hybrid working going forward.
Okay, don't think about I'm not productive at home, just to make that very clear. Libby, thank you so much for some great reporting. Libby Cherry there with this fantastic story on productivity and the hybrid working model that we are tending to go towards. Now, this is the markets. It is a quiet day, but actually, as our Eddie van der Walt beautifully put it, it's all about anticipation ahead of Jackson Hole. That, of course, is tomorrow with the Jay Powell speech. Stocks dropping today. There has been a bit of a retreat in technology shares. A lot of caution ahead of the Federal Reserve gathering that may also provide more clues about its approach to pairing stimulus. The dollar a little bit rising. We're also looking at some of the other things that have been moving the markets. I know my producers and I have been looking a lot at Chinese technology companies slumping on disappointing earnings, and again, Beijing's crackdown on private industries. Coming up, all eyes on Powell's Jackson Hole speech tomorrow. We'll be joined by HSBC's global chief economist, Janet Henry, who fears a delayed policy response to inflationary pressures. We'll discuss all of that shortly. This is Bloomberg. Watching Wyoming, investors' attention turns to the Fed's Jackson Hole meeting for any clues on tapering. Stocks waver, Treasury yields hold again. France's road to recovery just 8 months away from the presidential elections. Executive and politicians gather in Paris for MEDEF. The French trade minister tells us that labor shortages and supply chains are the biggest risk to the rebound. And Britain's biggest business group warns that consumer firms are turning pessimistic as they struggle to find staff after lockdown. Well, we'll discuss that and more with HSBC's global chief economist, Janet Henry, next. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Investors eager to hear any hints on tapering from Jay Powell's speech at Jackson Hole tomorrow. Now, the stakes are high. Tapering too soon may actually derail the economic recovery. Tapering too slowly could fuel inflationary pressures further. Well, HSBC's economic research argues that inflation is a bigger danger now than at any point since many central banks became independent in the 1990s. The most likely outcome may still be that inflation is transitory, but HSBC most fears a delayed policy response scenario. If tightening is actually too slow, it will have to be more aggressively, or it has to be more aggressive, resulting in greater economic damage. Well, we're joined by Janet Henry, global chief economist at HSBC. First of all, Janet, I'm delighted to see you. I feel like it's been way too long, and I hope next time it'll be in person. How do you look at Jackson Hole? It feels like the Delta variant just got suddenly worse, or not suddenly, but in the last 2 weeks, it's been really at the forefront. Could we see an even more dovish Jay Powell tomorrow?
Well, anything's possible, but it is always this big event, Jackson Hole, isn't it? This time last year, it was all about average inflation targeting that was announced at that time. But for the most part, markets are looking at this meeting thinking we've got low expectations. We're not going to get a strong steer either way. So it's almost as though we get any news, it could potentially have a reaction. And I think it will be about what he says on the kind of strength about the US economy, but the renewed and in fact heightened global concern about the Delta variant and indeed the risk of reduced vaccine effectiveness and indeed the risk of even more variants coming through. So he's going to have to tread a very fine line with this balancing act to not come across as too hawkish because he's so optimistic about the US, or indeed just too bearish because he's very much bringing forward this uncertainty and downside risks from COVID.
So, Janet, do you think actually there are more risks that they don't take care of inflation, quickly enough, and therefore they'll have to be much more aggressive once they start tapering or even hiking rates?
I think that the risks are more tilted in that direction, and certainly in the report that we wrote about, I did highlight the fact that we saw what happened in Japan a long time ago, where even initially after the bubble burst, they worried about inflation for too long. We saw what the ECB did with raising interest rates in 2008, and then again a few years later, it quickly had to reverse. So I think central banks globally are a bit nervous of the consequences of being a bit too trigger happy in responding to early signs of inflation. And now, we've consistently heard from the Fed that this is transitory. And we know that if we have got a long-term inflation problem, it's not going to be because of used car prices. It's going to be a consequence of a whole range of other factors. And therefore, yes, the risks are more skewed, not towards acting prematurely, but actually perhaps waiting too long before realizing that inflation is a much bigger problem. So, yeah, the risks are more skewed in that direction than at any point pre-pandemic.
Janet, what data points are you looking at to maybe, tell us that it's not as transitory as central banks think? Is it wages? Is it actually, a lot of supply chain issues are impacting, of course, inflation, but is it very difficult to see then prices normalize afterwards?
Well, that's what we're going to have to watch over the course of the next year. Regarding tapering, a lot just depends on what happens over the next couple of months. I don't think we're going to get anything on the pace or timing of tapering at Jackson Hole. That's an FOMC decision. They will agree that, but the September meeting will be interesting because we'll have another payrolls release. We'll see what's happening on this supply side, but not enough, because it won't be until October that we will have seen the end of this enhanced, when we get the September data, we will have seen the impact of this enhanced unemployment insurance wane. We'll have had one more inflation release. Then they can think about what their communication will be regarding the timing and the duration of the asset purchases. But in terms of what it means further out, and obviously for interest rates, I think what Powell will make clear on Friday is that there is no mechanism in terms of the link between the end of tapering and the beginning of rate rises. And for the rate rises, it will be about what happens to inflation in 2022. So I would be looking at not just prices, but wages as well. Do they continue accelerating through 2022, or do they start to roll over? Our scenario is that we don't see a further acceleration in wage growth, that more people do return to work. But obviously, this heightened uncertainty on COVID could mean that some of these supply disruptions that we thought were transitory and short term actually become longer lasting.
Janet, when you look at the Bank of Korea, what we heard from them today with raising rates, is that a warning shot for more rate hikes to come? And is it something that could happen in the region, or I don't know, whether we can widen it?
Well, absolutely. It's interesting. In fact, the title of our last report was Going Their Different Ways. And that wasn't a description of what governments are doing regarding COVID, although clearly we're seeing very different government reactions globally, in some cases to a handful of cases, and in others ongoing reopening where there are many tens of thousands of cases. But for central banks as well, we're seeing differing responses. Some of those emerging economies like Brazil and Russia that were very aggressive to raise interest rates quite quickly, and now we've seen it in Mexico, elsewhere. A lot of these countries were countries that had cut too far, or where they had deficits and they're worried about capital flows. But what we're seeing in Asia, and I think Korea is probably the first, but it's not the only central bank talking about it, it's more of a financial stability concern. Inflation is not of great concern in Korea, at least not yet, but they are more concerned about financial stability. Arguably Norway is as well, maybe New Zealand, why they'll also be early to raise interest rates. Whereas when we look at the Fed and the ECB, it's much more about what's happening in inflation, what's happening in labour markets, and perhaps that they won't take their eye off the ball for financial stability reasons, but they won't let financial stability be the primary driver of the timing of when they deliver the first interest rate rise, in the same way that we're seeing in Korea. And I think it's going to be a very gradual tightening cycle in Korea because of the motivation for even starting to raise interest rates.
Janet, what's your take? So yesterday there was an interview by Philip Lane that basically says, the ECB is watching for any, spillover effects from what the Fed could do next. And then we have the ECB minutes. How tricky is it to be a European central banker right now?
I think it's very tricky because obviously every central bank, particularly the big ones, have to take account of global developments. Now, the ECB will have been probably pretty happy to have seen the dollar appreciate. That's, if anything, helped to ease financial conditions in the Eurozone. For the ECB, they're looking at the Eurozone economy where the data have been quite firm, and they know that financial conditions are very loose. but they also want to slow down the pace of asset purchases. So in many ways, if the Fed was to move sooner and quicker on tapering the asset purchases, that might make it easier for the ECB to do so. The difficulty as the ECB moves towards September is that if we haven't had any clearer indication on what the Fed is going to do and how quickly, they will perhaps still want to taper their asset purchases, but won't want the market to think that this is hawkish. It will be tapering, is not tightening. Conditions are still very loose. And again, they'll have to tread a very fine line. And they too may decide, what's the urgency? We can wait another month. We can see what the Fed does, what signal they send before we actually announce a scaling back of the asset purchases. And the risk is, of course, that it undermines their whole new framework, their credibility about this forceful response if they are seen as tapering the asset purchases a little bit too quickly.
Janet, thanks so much. Janet Henry, their global chief economist at HSBC, stays with us because some empty shelves in UK supermarkets as labour shortfalls and supply issues hit food distribution here in the UK. So with Janet, we'll talk about the UK, we'll talk about supply chain issues and wage growth. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now in the UK, a labour shortage in key industries from haulage to food processing is actually disrupting supplies in some supermarkets and restaurants. Britain's biggest business group, the CBI, says recruitment difficulties are also hitting investment. Well, Bloomberg's consumer and healthcare editor, Deirdre Hipwell, joins us now. Deirdre, great to have you on the program. I mean, this is like such a huge story. Why is the situation in the UK so much worse than elsewhere?
I think it's difficult everywhere, but I think in the UK what we have is the Brexit angle, which is creating further complexities for businesses to deal with. In particular, we have lost a lot of workers who've returned to their home countries in the EU. So we've lost fruit pickers, workers in warehouses, and we also have a huge shortage of lorry truck drivers. And that's a big issue in a country that imports a lot of consumer goods and food, and also in a country where there is a high degree of people shopping online and they need their deliveries to their home.
I mean, so we're looking at some of the shortages, as you say, milk shortage, poultry jobs that are difficult to fill. This means that Nando's has had to close some of their shops down because they don't have enough chicken. It means that, milkshakes at McDonald's are also hard to come by. At the end of the day, what does it mean for consumers? That they can't have it, or that they're going to pay more for, milkshakes that they are able to get their hands on?
I think it could be a bit of both. I think consumers have to brace themselves for the fact that prices are probably going to rise. Businesses can only sustain huge increases in the cost of their supply chain for so long before they inevitably have to pass that on. That said, businesses are doing an awful lot to try and prevent that, but it does mean that some of the measures that they take to reduce increasing prices is a reduction in the range. So they focus on getting the core goods in so that we at least have what we need, but perhaps less choice.
All right, Deirdre, thanks so much. Deirdre Hipwell there, Bloomberg's consumer and healthcare editor. We're back with Janet Henry, global chief economist at HSBC. Janet, I mean, some people may laugh. It's no laughing matter if you can't get a milkshake or, chicken at Nando's, but it does point to something a lot deeper, actually. And I don't know whether, as an economist, you see that as impacting, inflation, and therefore what the Bank of England does, or I guess, rising inequality between people in the UK.
Yes, it's very difficult. And as you point out, it's an area of huge uncertainty for a central bank. And, it's not just in the UK, but, it is something that Powell will be talking about. The whole theme of Jackson Hole is the income inequality story, but also what he'll be playing up is the uncertainty about the outlook. Yes, central banks, for the most part, think that this rise in inflation is transitory, and the labour shortages and other supply shortages that we're seeing globally, but in the UK in particular, because of the Brexit-related issues that your journalist just referenced, means that the UK faces a particularly acute issue in certain areas. And central banks almost have to, policymakers have to take a view on what is the balance of risks, what's the distribution of those risks. Is it going to run its course, or is it going to be longer lasting? And I think this is the big challenge on the UK, where there's still an assessment being made about what is the supply potential for the economy in a world where we don't have free movement of labour for some of the lower paid and arguably lower skilled jobs, which is also playing into some of the political debates.
So, Jen, I guess there's no easy fix. How do you fix this?
Well, anything that kind of adds friction into the economy is typically assumed to be bad for growth. What we saw globally in the last 20 or 30 years is quite rapid globalization and such like, increasingly free movement of goods and services, and of course, labor. That was good for supply potential globally. This time around, obviously, we're adding friction, whether it's at the global level with frictions between East and West to some degree, and in the UK with Brexit, where we're not going to get the same free access to labour. So we have to improve skills. We have to improve productivity amongst the existing UK workforce, and potentially there may have to be some adjustments in policy to classify certain jobs as actually skilled jobs, so we can open up those sectors to greater inflows of labour.
Janet, when you look at some of the supply chain issues, I mean, a lot of it is also, some of the ports being closed. I think there was the third largest one in the world in China because of this zero tolerance COVID policy. So how do you make a distinction between, the supply chains that could actually reopen quite quickly as, when the pandemic stabilizes, and the others?
You don't really, and this is what we just have to watch the high frequency data for in various countries as well. It's quite interesting, even when you look at the US at the moment, you look at jobs growth in certain sectors, and you look at wage growth in certain sectors. And in the US, a bit like the UK, leisure and hospitality is one of the areas where there's been the most extreme shortages. But the number of people employed in that sector is still about 10% below pre-pandemic levels. So we know there are certain things we're watching for. So we're watching for children going back to school and not needing the homeschooling, hopefully, to the same degree, or same caring responsibilities, and to see whether that supply shortage actually continues to ease. We know in other sectors like tourism, if tourism is still constrained by various regulations, or people are being unwilling to travel, that actually those areas of the labour market still need some ongoing support. So, for economists and policymakers, we're looking at the aggregate data, but actually in terms of these opening up and closing of the different sectors, it's very difficult to forecast what that means at the aggregate level. Again, playing into the whole area of uncertainty.
Janet, thank you so much for all your time today. Janet Henry, there, Global Chief Economist at Hsbc, joining us this morning. Now let's get straight to your Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. OnlyFans has reversed a decision to ban sexually explicit material after uproar from creators and sex workers who rely on the platform for income. Last week, the social media site said it would ban explicit content from October, a decision it blames on pressure from banking and payment services. But the site now says it's secured assurances necessary to support its content creators. Shares in Rocket Lab failed to take off in their first day of trade, tumbling almost 10%. The American space launch provider raised $750 million through a SPAC listing, which it plans to use to build its largest rocket to date. Rocket Lab bills itself as SpaceX's only direct competitor.
We build satellites too. We have multiple missions, and our team is flat out building 2 satellites to go to Mars for NASA, 1 satellite to go to the moon, and we already have 2 of our own satellites on orbit already.
That's the Bloomberg Business Flash. Francine.
Laura, thanks so much. Now, coming up, the EU is set to discuss reimposing travel curbs on the US. We'll get into how the turbulent summer travel season is playing out next. This is Bloomberg.
International should start opening once we get to 80%, which we also believe will happen by the end of the year. And then we'll open up to countries, the government have said, have similar levels of vaccinations. So the UK, the United States, at least the west coast of the United States, Singapore, Japan, Canada. And that's what we're planning, start the operations from the 17th, 18th of December, those countries that we believe are a possibility. Where it is dependent on a decision the government haven't quite made yet, which is what the quarantine requirements will be for vaccinated travellers.
That would make a lot of people happy, Alan, but of course there's lots of uncertainties. There's already criticism that even at 80%, there's people saying that we shouldn't reopen given how high cases are. And if you look around the world, there's a chance that we may never get to 80, 90%.
What you're seeing happening at the moment in Australia is the biggest uptake of vaccinations, higher than the peaks in the US or in the UK when they were rolling around at the start and there was overwhelming demand for it. And we see that continuing. So we're comfortable that we should be able to get to those 70, 80% targets.
Well, that was Alan Joyce, the chief executive of Qantas, speaking to Bloomberg's Heidi Strout-Watts. Now, the outlook for travel is also a major theme here in Europe today. The EU set to discuss reimposing travel curbs on the US due to soaring numbers of coronavirus cases. It comes as we're getting to the end of a turbulent summer travel season. Well, joining us now is Bloomberg's Laura Wright. Hi, Laura. So what's the latest travel picture in Europe?
Well, we are seeing a recovery in Europe, Francine, and OAG data on seat capacity supports this. Conversely, passenger traffic in China has fallen to its lowest level since February. And in America, well, the Bloomberg American Airlines Index, that also fell to its lowest level since February. So some of the reasons why we've seen this momentum in Europe, well, remember back in May, Greece opened its borders unilaterally for double vaccinated tourists. In the United Kingdom, we created the traffic light system, and the European Union welcomed double vaccinated Americans into Europe. Since that decision, transatlantic travel from America to Europe is at 50% of pre-pandemic levels. But what is most important, Francine, in July, the European Union created their digital COVID-19 travel pass, effectively opening European borders for intra-European travel.
So, Laura, how are European airlines actually performing?
Well, there is a differential coming through between long-haul and short-haul carriers. You can see from my chart here, stock prices normalised over the pandemic. IAG and Air France at the bottom, followed by EasyJet and Ryanair, a clear standout. Ryanair's stock price actually higher now than it was before the pandemic. Ryanair set to make a profit this quarter. Now, in terms of seat capacity for this week, the 23rd of August, Ryanair stands at -7% compared to the same week in 2019. For British Airways-owned IAG, seat capacity stands at -60% compared to the same week in 2019. Another thing worth noting, however, is this differential between Ryanair and EasyJet. And it's interesting because Ryanair, headquartered in Dublin, the European Union, they can benefit from that intra-European travel that I was talking about because of that COVID-19 digital travel pass, whereas EasyJet, located here in the United Kingdom, we are subjected to expensive PCR tests, which is a deterrent for travellers.
Laura, thank you so much. And sometimes the rules also change often at the last minute, so people are a bit wary of that when they go on holiday from the UK. Now, thank you, Laura. This is what we're looking at overall in terms of stocks. Now, stocks are definitely retreating a little bit. There's one story that we need to keep an eye on, and this is Deutsche Bank's asset management arm, DWS, slumping after a probe into its sustainability claims. This is a further sign that authorities are really taking a tough stance on potential greenwashing of investment products. This is Bloomberg.
Undoubtedly, the involvement in the Fed has distorted these markets, and, the involvement of the change of policy focus.
I don't think Jay Powell wants to upset the apple cart. I really don't think he's going to try to push people in one direction or another.
What I'd like to see out of Jackson Hole is for the central bankers to say, this is an emergency policy response. This isn't a normal part of our toolkit. They need to draw the line somewhere here.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
Well, it's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, August 26, and our top stories today. Searching for clues, investors hope the Jackson Hole Symposium will give them some idea of what the Fed will do next. Was it greenwashing? U.S. prosecutors are investigating whether Deutsche Bank's asset management arm overstated sustainability metrics on some investments. And Banning America, the EU discusses whether to reimpose coronavirus restrictions on visitors from the U.S. Well, I'm Francine Lacqua here in London, Matt Miller in Berlin, Lisa Abramovitz in New York. Kailey Leinz is off today. Lisa, I spoke to our Eddie van der Veld from the MLive team, and I said, look, the market is directionless. Maybe it's a tad boring. And he said, how dare you say that? It's all about anticipation ahead of Jackson Hole.
Well, that's, I mean, his job, right? He's going to say, look, this is literally what I do as I track it. You're going to say my job is boring. In all fairness to him, though, we have had 51 straight days, not straight, but 51 record highs in 2021. Yesterday, we saw another one, although creeping just a little higher, and today's a little bit softer. And perhaps this is stemming a little bit from over in Asia. We are seeing a sell-off after 3 days of gains, particularly in the tech stocks in China. People now retracing some of those gains, selling those equities as people take a look at some earnings that did come in disappointing. You can see the Shenzhen's down nearly 2%, and the Kospi's down about 0.6%. Meanwhile, over in Japan, pretty much range-bound ahead of the Federal Reserve meeting in Jackson Hole. Not really meeting there anymore. It's going to be virtual. Meanwhile, we're seeing, this is to me really interesting, the technology stocks getting a sell-off after 3 days of a reprieve, down about 2% at 121.94. Other interesting move overnight, the Korean won actually weakening versus the dollar. This is a surprise given the fact that the Bank of Korea actually was the first major Asian economy to raise rates from 0.5% to 0.75%. So why the Korean won weakness, you should ask? Well, the reason why is because some people were anticipating perhaps another rate hike come November. Now people are stepping back and thinking perhaps they will hold off for a little bit longer. Over in the U.S., a little bit softer tone here as we head into the trading day, although we tend to see some strength as the day goes on. S&P futures down almost 7 points to 44.86. And the 10-year yield creeping higher. This to me is interesting. We definitely have seen bottom 135 ahead of that Fed meeting. A bit of dollar strength, and crude just a touch lower. Matt, what you seeing over in Europe?
Well, over in Europe, we see some pretty deep losses, Lisa. Not 1%, but if you look at the world map on your Bloomberg terminal, you can type WM to get that. You'll see some bright red there. We have bigger losses in Germany. The DAX down about 0.7%. Bigger losses in Spain. The IBEX down about 0.8%. And you don't really see any green until you get all the way east to like Slovenia and Croatia. Everywhere else is down right now. One of the interesting things, I think, is that it's another one of those days where we saw such big moves yesterday that even reversals today don't look so bad. For example, if you look at the bunds right now, you can see that we're down to negative 40 basis points, or maybe I should say up to negative 40 basis points. So we made some real gains yesterday. Same is true with Brent crude, 71.57 a barrel. Okay, it's down right now about 1%, but it had come up so much that Brent now looks more like Brent than it does like WTI. And so those gains are getting sold off, but maybe it's just a little bit of profit taking, Francine.
Yeah, it could be a profit taking, or it could be the Delta variant, something definitely to keep an eye on, Matt Miller. Now, a look at what else is ahead today, and the virtual Jackson Hole Economic Symposium kicks off today. We'll hear from a slew of Fed governors ahead of J. Powell's speech tomorrow. At 7:30 a.m. New York time, we'll also get the minutes from the ECB's latest meeting. We talk about the Philip Lane interview that was doing the rounds yesterday. Then the Israeli Prime Minister Naftali Bennett visits Joe Biden at the White House today. Iran will be high on their agenda, and the European Union finally will discuss whether or not to reimpose curbs on visitors from the U.S. as new coronavirus cases soar. So the Delta variant upending every model of success that's emerged in the past 18 months, sending countries once ranked as amongst the best places to be during COVID tumbling. In August, European nations were actually the most resilient, with a middle ground strategy of widespread immunization and reopening based on vaccination status. So let's get more on all of this with Bloomberg's Ritika Gupta. Ritika, if you look at the ranking, just came out, wonderful, Bloomberg proprietary. France, for example, is not doing too bad.
Yeah, it's not, Francine, and we have to talk about this COVID-19 resilience tracker because we really have seen some stark changes in the month of August. It really is your European countries that are leading the way on this board here. 9 out of 10, in fact, from Europe, and Norway leading the charge here. This is for the second month in the row. This is the highest. It actually replaces New Zealand, which, if you can believe it, dropped 26 places because they went from being one of the most relaxed to one of the most restricted, as we saw, or strictest, as we saw, with them shutting down the whole country with just one COVID case. And we also see those that had been leaders in the vaccination, in the reopening, like US and Israel, they've dropped also as the Delta variant has picked up. And as to what's at the bottom, it's actually those Southeast Asian economies where we've seen the Delta variants become an epicenter there. The likes of Thailand and Malaysia actually the last place at number 52.
So at the end of the summer, it's a total reversal of what we saw at the beginning of the summer then, Ritika. The U.S. is doing so poorly, and Europe is doing so well that the EU is now thinking about new travel curbs on Americans, right?
Yeah, Matt, this is going to be a very contentious issue. EU having these discussions of whether to reimpose the travel bans or curbs for US travelers. They had lifted them back in mid-June. This is when the COVID cases were kind of dwindling in the US. Now they are starting to surge up again. If we look at the latest data, 507 new cases per 100,000 inhabitants. That's in the first 2 weeks of August alone. That is way above the EU limits at 75. So this is really what is driving that conversation here. But they do need the majority of states, though, to agree to this proposal. This isn't going to be great for the airlines, the likes of Deutsche Lufthansa, Air France, KLM. They're not going to be liking this so much as well. You can see them down in trading. We had actually seen EU-US travel routes rebounding nearly 50% of pre-pandemic levels. So this is also going to be a contentious issue because the US hasn't lifted travel restrictions for places like the EU. So there's no reciprocity there. So again, it's going to be interesting to see what comes out of that.
Yeah, Ritika, I mean, there's so many conferences actually with U.S. executives that are meant to come over in September, October. Our very own Matt Miller is also getting married with family coming over. So it'll be something that people really want to know about, and we'll find out a little bit more later today. Ritika Gupta there with the very latest. Now, Deutsche Bank's asset management arm DWS slumped after a probe into its sustainability claims. Let's get more on this with Stephen Ahrens, Bloomberg's German banks reporter. Stephen, if you look at DWS, I mean, the share price is down some 12%. I mean, this is a huge loss. Is this a DWS problem, or could it be a financial problem with greenwashing?
Well, I mean, it's clearly a DWS problem. There's no doubt about it. I mean, the share price says it all. It's prosecutors in the U.S. looking at this, so this could have some severe repercussions for this asset management unit of Deutsche Bank. The lender holds a 75% stake in the business. But yeah, I mean, it could have wider implications as well. It's the first time that we know that prosecutors are looking at greenwashing allegations, and if they actually come up with a fine or even more, that could mean the industry itself is under scrutiny for their ESG claims.
We can see that it absolutely decimated, literally, shares in DWS. How much of a headache is this for Deutsche Bank and Christian Saving?
It's yet another headache, you really have to say. Saving is facing other legal problems. The U.S. Federal Reserve has criticized Deutsche Bank for ongoing compliance issues. The German regulator has recently expanded a mandate of the monitor it's installed at Deutsche Bank to oversee its efforts in building out its anti-money laundering capabilities. All of these things are happening as the CEO is trying to boost profitability. And each time this happens, each time a new probe opens up, it's a setback because he needs to devote resources to that probe, to remedial action. And of course, it's always a reputational issue. Deutsche Bank is down a little as well today. So yeah, it's definitely another headache for the CEO here.
Stephen Ahrens of Bloomberg, German banks reporter, thank you so much for that and for reporting on the issue. Over to Afghanistan, the U.S. believes there are about 1,500 Americans who are still in Afghanistan, but Secretary of State Antony Blinken doesn't think all of them are trying to leave.
It's hard to overstate the complexity and the danger of this effort. We're operating in a hostile environment in a city and country now controlled by the Taliban, with the very real possibility of an ISIS-K attack.
Joining us now, Emily Wilkins, Bloomberg government reporter in Washington, D.C. Emily, what resources will be available to Americans who do remain in Afghanistan once August 31st has passed and U.S. Troops and other presence has been departed from the nation?
So we did hear Secretary Blinken say yesterday that for the Americans who choose to remain in Afghanistan, there still will be resources available to them. They will be able to leave the country. Blinken said that it would be something that they would be working on every day. And remember, Lisa, there's still immense pressure out there for the Biden administration to go ahead and extend that August 31st deadline into September. You heard the pressure from the G7 leaders. You're hearing it from lawmakers within his own party. And I think there's still a big question about what's going to happen in the next 6 days as things wind down. But getting back to those American citizens, particularly the 500 that the U.S. has had immense contact with, that Blinken said that they are keeping an eye on and trying to get out of the country, they really only have a couple more days to do that, because what needs to happen is after that, they're going to need to get the military that's currently there out of the country, and that's going to take several days as well. So the timeline here is really closing to get those remaining 1,500 Americans, or 500, however many wish to go at this point, out of the country.
Well, and it's not just about Americans, right? I mean, a lot of the public is concerned about the Afghans who risked their lives to help us in return for the promise of protection. Are they important as well to the Biden administration? Because it seems like they sort of get lost in the mix here.
Absolutely. And yes, there is a focus on American citizens, but there's definitely also been a focus on Afghan allies, those who help the U.S., those who have the visas and who want to get out at this point. And the U.S., they are saying that they will be working to try and get those allies back to the U.S. They are working with other countries to see if there is the ability for those refugees to go there. President Biden is actually having a meeting today with governors to try and figure out where these refugees can go. A group arrived in New Jersey earlier today. And so there definitely is a focus on making sure that those Afghanis who have helped the U.S., who have the permission to come over, are able to do so. But there's also that primary focus right now, I think, on American citizens and making sure that those who need to get out are able to do so.
Emily, thank you so much. Emily Wilkins there of Bloomberg Government. Of course, we're August 26th, and the withdrawal is 5 days away. Coming up this hour, Luke Hickmore, Standard Life Investment Director, and former French Finance Minister Pierre Moscovici. Then a little bit later, today and tomorrow, Bloomberg has full coverage of the Jackson Hole Economic Symposium. It kicks off with our interview with the Kansas City Fed President Esther George. That's at 7:30 a.m. in New York, 12:30 p.m. in London, and this is Bloomberg.
We're in still completely new territory.
I think this Jackson Hole is going to be very interesting.
The biggest risk for markets is simply we're learning as we go in terms of what the policy responses are going to affect.
I think the risk today is that inflation overheats. The risk is not that, they've achieved their goal.
The Fed's motive here is to keep the financial system functioning and liquid, which they've done a very good job of.
But that inflation targeting dynamic is I would argue, a bit archaic, as recent as that was, a bit archaic today in an environment where the risk to the system is an overheating inflation.
It feels like everything has been happening at lightning speed. We've gone through an entire economic cycle, it feels like, in the space of a few months.
And at this point, when the market and the economy can carry itself, what we need to see is the Fed beginning to mop up all that extra money.
Well, a few there of the expectations ahead of the Fed's Jackson Hole meeting. Now we're joined by Noor Al-Ali, our Bloomberg Markets live editor. Noor, thank you so much for joining us. I mean, first of all, so we have half the people saying, well, we're not going to really get much from Jackson Hole. It's been interesting in the past, it'll be fine, but not that interesting. And others saying, if you look at the Delta variant, we could see an even more hawkish Jay Powell.
Well, I mean, honestly, I'm just going to tell you what an exciting time to be in markets right now. It is your absolute last chance to determine what side of the camp you're part of. But the real thing here is that Powell can't really get away from a moment where he does not give clarity for markets, because that's precisely what they're looking for. If you look at the Treasury yields, they've just been wobbling about range bound since mid-July. And I expect something to come tomorrow, at least at the very least, some kind of formal indication of where the tapering debate is going to come from the Fed.
Exactly. And so what do we expect, Noor, at the MLive blog in terms of when tapering is going to start, how much is going to be tapered, and how long it's going to take?
So the real question isn't when it's going to, I mean, well, sure, we'll go there. So the MLive blog, we're currently having discussions behind the scenes of when it's going to really start. So the question here, is it going to happen in 2021? Realistically, I think that's very possible. Whether it's in September or December, it doesn't really matter at the moment. But the fact that it may happen in 2021 is exactly where it's headed. I mean, what's really weighing on the sentiment for the Fed is real yields. They're at the lowest level since the oil crisis, the very first oil crisis, and what's known as the Great Inflation, when the Economic Council referred to it as the Hydra-headed monster. We're not there yet, but obviously that's something that's weighing on the Fed right now.
Nora, which assets have been most inflated by Fed policies, and thus which assets are most prone to a potential reaction to anything that happens tomorrow at the 10 a.m. speech with Fed Chair Jay Powell?
I mean, I don't know. I think we at TV here, you all know what TINA stands for, and there's just nowhere else to go, unfortunately. Stocks have definitely been the biggest contributors. And I always talk about this. I mean, if your family's still paying your bills and you're well into your 20s and you're making a lot of money, obviously you're going to keep making more money. So this is a case where, you know, stocks are definitely have seen a bit of a height there. And obviously as well, yields too. I mean, they're definitely going to continue to go lower. Some numbers here because we really care about them. The Fed is currently buying. Yes, go ahead. Sorry.
Well, I just want to get back. Who said the Hydra-headed monster? Because I love, there are always great inflation quotes out there. Ronald Reagan said, inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. Let's get back to the Hydra-headed monster comment.
So this was back in 1974, and this is a history lesson for a lot of us here because I'm too young to remember this. And
don't rub it in. Don't rub it in.
No, but some people do actually still remember this. And so this was back in 1974 during the Great Inflation period. We had an 8-year of economic crisis there and really trying to tame inflation. And the Economic Council came there in 1974, and it was page 21 of that year's clear policy date where they said inflation is a Hydra-headed inflation. And however many times, and now I'm paraphrasing because I didn't memorize the full quote, however many times you try to tame it, you cannot do that. More heads come out. And so I don't think we're there yet. I mean, the Fed does think inflation is going to be transitory, and I'm sorry to keep throwing that word around. If you look at inflation swaps, and I'm always going to talk about inflation swaps here, and it's a great function on the Bloomberg terminal. It's ILBE. You toggle onto the inflation monitor screen, and you'll see exactly where the market is looking at when it comes to inflation. And realistically, this 3-month measure forward-looking number has gone down.
Nora, thank you so much. Page 21, Matt Miller, I expect you to memorize, and actually you're going to be quizzed on it. Nora's coming back tomorrow to make sure that you've memorized it 100%. Noor Al-Ali there of Bloomberg Markets Live joining us. We'll have plenty more on the markets, on Jackson Hole, and everything else. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London, Lisa Abramowitz in New York. Now let's get some of your first word news for you. In China, President Xi Jinping says the country will strive to meet key economic and social development targets despite the pandemic. Xi was quoted in a front-page story in the People's Daily. He said China must build a prosperous city and a prosperous countryside. There are new signs that China's V-shaped recovery has been slowing down. The labor shortage in the UK is leaving consumer businesses pessimistic. That's according to a survey by the CBI, Britain's biggest business group. The survey found optimism at minus 17% this month. That's down from a positive reading of 47% in May. Businesses such as restaurants and bars can't find enough workers to fill jobs after lockdown. And Prime Minister Justin Trudeau in Canada took a populist turn in the country's election campaign. He promised to impose a 3% surtax on the nation's big banks and insurers. Industry groups aren't happy. They call the tax counterproductive and warn it could hurt the economy. Bosses in Manhattan have lowered their expectations for a return to office next month. Cases of the Delta variant are on the rise in New York, and a survey by Partnership for New York City says employers now see 41% of office workers returning by September 30th. That's down from an estimate of 62% in May. I will point out here that I have never worked from home, Francine. So part of it's just about commitment to your job, I'd say.
Well, not really, but we have actually done some analysis. Lisa, I find it fascinating because actually productivity increases 5% if you work from home 1 day a week, except for me. I'm not productive at home.
I will just say, I think it's going to be a really hard transition. People have been working from home for 18 months. Tough transition.
Yeah, it's like, waking up from a long slumber. Coming up next, we talk markets with Luke Hickmore. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, Matt Miller in Berlin, Lisa Abramovitz in New York. Kailey Leinz is off today. Matt, we look at the markets. They're quiet, maybe not for long as we look ahead to Jackson Hole, but Lisa was right. It's like the 51st session where we're seeing record highs in the U.S. 51 sessions, not 51st.
51st, 52nd. Is it? Have we seen 52? I think Lisa said 52 at the top of the show.
No,
is it 52 so far?
Just for fact check, there have been 51 record highs in 2021. Today, the equity markets seem to be indicated a little bit lower. But if we got another record high today, it would be the 52nd.
Number 52. Yeah.
Or
yes. Okay.
Got this straight.
Not in a row, as you pointed out, but yeah, it still is. It's pretty amazing. And the interesting thing is that there are no more bears out there. You would expect after this many record highs that more and more people get bearish, more and more people start putting on bets. This can't last forever. We've got to go down, but you don't see that, do you?
No.
Yeah, I think was there a bank actually? I don't know whether it's Wells Fargo yesterday going to 50 or 5,000 for the S&P 500 in 2022. UBS, there you go. I don't know. Is that playing out in the markets today, Lisa?
I mean, right now you're seeing a little bit of a dip, and frankly, you're seeing particular stock movers, but otherwise pretty range-bound in a day where perhaps we are going to see a bit of uncertainty ahead of tomorrow's Jackson Hole speech from Jay Powell. What I'm looking at today is that downdraft that's bleeding over from Europe with a 0.5% decline in the stocks. Europe, S&P futures indicated just a touch lower, 0.2%, not even 44.85, and 10-year yields creeping a little higher. I find this interesting given where we were just a couple weeks ago, 134.91, almost 135 here, at a time when people are looking at perhaps a shift up toward 2%. We're still hearing some 2% yield calls, although I struggle to understand how we get there while also seeing the strength in the equity markets that so many people predict. Now to get some sense of what specific stocks are moving in pre-market trading in the U.S., Salesforce, this customer relations software company, beat second quarter bottom line estimates, boosted its full year outlook. Lots of good news, and its shares up a little more than 2%. I mean, this really highlights how high expectations really are. There is a bit more of a boost to Amneal Pharmaceuticals. It's the most active stock in the U.S. pre-market. They had a Parkinson drug trial that met its main goal. A new treatment basically will help the company combat some of the competition from generic drug companies. Their shares are up more than 10%. And then Zoom Video is rising in pre-market as Morgan Stanley upgrades the video conferencing software stock to overweight. The analyst sees more durable growth. The upgrade, though, however, is based on overdone market concerns around the stock. As much as, Matt, you did not necessarily work remotely, a lot of people did, and Zoom benefits from that. Matt, what you looking at?
Yeah, I will say also, Lisa, Salesforce, it is a massive company. So any move up is significant because we're talking about a $240 billion company. They're worth about the same as Oracle. And and both are worth far more than SAP, which is what I think of.
Okay, I get your point,
yes.
and I will let you continue with your information. However, we saw pretty big moves even in Amazon, which is even bigger than Salesforce. And I will just say that given the fact that they beat to such a degree, you would just think it's notable. That's all.
It is notable, and I'm glad you note it. Amazon, to me, what's shocking about Amazon, flat for the year. In fact, down over the last 12 months.
Right.
So, you know, a lot of people backing up the truck there. I have got a fantastic chart, again, from my producer in New York, Dan Curtis, Olympic-level rower, and also an incredible chartist. And it kind of says the opposite of what Dave Wilson showed us yesterday, in that we're seeing the same signals from bonds as we are from stocks. They're positively correlated. Now, a little disclaimer, I myself don't put a lot of value into correlations because you can always manipulate them like statistics and make them tell whatever story you want. But I love this bottom part of the chart. For those of you listening on radio, I welcome you. You can't see it. So what I'll tell you is we have correlations, positive and negative. It looks like every 6 months. So things go back and forth. Fortunately, we have a couple of fixed income experts with us. Lisa is with us for a couple weeks. Luke is joining us just for today. Luke Hickmore, investment director at Aberdeen Standard Investments. Luke, what do you think about this correlation in the sort of everything but gold rally that we're watching?
Well, let's ignore the chart crime you're committing with two different axes rather than normalising a chart. Ignoring that for a minute, Matt. It is chart crime. Ignoring that for a minute, I mean, it's all around QE, isn't it? You know, that we've suppressed bond yields. Oh, the central banks have been busy suppressing bond yields all year last year, and really, I guess, in many ways, way back to 2009. Let alone they're fighting inflation for the last 32 years. And let's be clear, lower bond yields in many ways can be good for stocks. We saw that with the tech sector last year, and tech sector is such a large part of the S&P 500 that it tends to drive the overall index level as well. So lower bond yields, it's kind of suggesting that could push up your tech and S&P as well. So it's no real surprise, and it's why we're all on very gentle tender hooks ahead of Jackson Hole tomorrow.
Yeah, well, absolutely. And I just wanted to, you know, while we have Lisa here, ask her take as well on, I said there's no bears, it looks like, in the equity market. We do have, though, people that are betting big against fixed income, against treasuries. But we don't see this rally turning around anytime. Well, we haven't seen it turning around anytime in the last few years, have we?
Well, and frankly, Matt, there is no more painful place than being a treasury market bear over the past couple of decades, and that has borne out again this year. And so, yes, there are people who are forecasting a rise in yields, and we have seen a rise in yields in the past week or so. But honestly, this to me is one of the big questions. How long will it take before all the treasury market bears are absolutely blasted out of the water, especially as you hear a consensus that treasury yields will rise to at least 150, if not 175 by year end. I mean, Luke, I'd love your impression on that, this idea of the bears left in the treasury market as the consensus, frankly, calls for higher yields ahead.
I've done it as well. We've all called for 2% in the US 10-year when inflation seems to be taken off back in February, and proven wrong again about inflation and again about yields. And I think for me, it feels we've been doing this for the last 3-4 years. Never mind, just forget the pandemic here if you can for a minute. It doesn't seem to make an awful lot of difference. And I think that the issue here is around who's buying, not who's selling. And even when we move Fed out of the equation at some point over the next year, that will happen, we've still got so many central banks who are in the pot, buying treasuries, buying their own markets, supporting investors with cash flow and suppressing yields. So, you know, it's hard to see it pushing much higher than 150, 175, but I'd love to.
But look, okay, you'd love to, but what is exactly supporting equities right now? So at what point, like, what does it take for equities to correct? Is it just money? If people have money and they want to put it somewhere?
That's certainly going to be a large part of it. And let's clear here that we've had a really good reporting season through Q2, both in the US and Europe, and through kind of credit markets and high yield as well. It's been pretty decent, actually. So, you've got some fundamental support that we're just coming out of. We've still got a lot of money in the system. There's still money being pumped in the system. That's not really a condition for me for equity markets to collapse. We say this in August, and September tends to be one of those months when, of course, equity markets do collapse. However, I just can't see that happening right now. We'd have to see that economy coming off the top, slower growth, slower earnings, and the prediction of that to start happening, which, they're still predicting higher earnings growth over the next year or two.
What do you expect then? No tantrum from Jackson Hole, and it's kind of even more tame now that it's again via video. What would we have to see to freak out fixed income markets tomorrow?
What, as a fund manager, would stop me going anywhere near bonds from tomorrow afternoon? Powell saying, that's it, we're going to start tapering in September, and we're going to start taking down from 35% of GDP to 15% of GDP, and we're going to do it in a year, and we're going to do it through active selling of treasuries. All of that would clearly be pretty bad. I don't think we're going to get any of it, though. It feels like, the actual decision could be getting pushed out after Kaplan's comments earlier in the week. It feels we could be looking at New Year before we see tapering come in, and they're very, very keen to avoid the tantrum again.
Luke, thank you so much. I love the fact that, Matt Miller said that it will be a little bit more tame because it's virtual. The idea of central bankers running around loose if they saw each other in person is something that I won't quite get out of my head today. Luke Hickmore, investment director there at Aberdeen Standard Investments. Now, coming up next, we talk about markets, debt, and much more with Pierre Moscovici. He's a former French finance minister and current president of the French Court of Audit. This is Bloomberg. This is Bloomberg Surveillance Early Edition, and you're looking live at the Principal Room. Coming up a little bit later today, Mary Barra, Chairman and Chief Executive Officer of General Motors. This is Bloomberg.
The summer was quite good for tourism in France, thanks to French tourists, European tourists, but also tourists from all over the world, and specifically the US. We need American tourists for our economy, and we need that American citizens could come to Europe, to France, for business as well. So we are looking very carefully about how we could deal with the restriction, with the health situation, but also to facilitate circulation between the US and Europe.
Well, that was France's Minister of Foreign Trade and Economic Attractiveness speaking earlier on Bloomberg from MIDEF, the conference organized by France's biggest business lobby. Now, joining us now from the conference is also Pierre Moscovici. He's a former French finance minister, current president of the French Court of Audit. So, Mr. Moscovici, thank you so much for joining us on Bloomberg. First of all, you're looking at public debt, you're looking at what France can do and what will happen in the next 3 to 4 years. How worried are you that debt is rising because of the pandemic and will be very difficult for a couple of countries in 3-4 years from now in Europe?
Sorry, I didn't hear the question well.
So, Mr. Moscovici, I was asking you about French debt levels. Are you worried?
Oh, I'm not worried because these levels are quite high, but they are sustainable for the time being. But we must be ready to adjust and to reduce them in case the inflation goes up and the interest rates goes up too. We cannot bet on a permanent negative interest rate policy by the central bank as the only leverage we have to control our debt or to master our debt. This is why after the moment when we recover the GDP level of the pre-crisis, which will come soon, we need to have a policy which will be stricter on public expenditures. Not austerity policy, but a serious policy for public expenditure is absolutely necessary in this country. I would say from 2023, with the idea to reduce seriously debt by 2027.
Right. How will this play out? Does this, show up in the conversations as France heads to the poll in the first quarter of 2022, or will there be much more pressing issues?
Well, I think that France is in quite good situation now as far as growth is concerned. And we will have, as everybody knows, also a presidential election in early 2022. So it's difficult to imagine a strong adjustment before that. But I think it must be in the debate. And the debate must be about how we can recreate a sustainable growth in this country, but also have a sustainable debt. And both of these issues must be central in the democratic debate that we're going to have.
We have very important German elections, of course, coming up in September. What role do you think France and Europe should play in this global growth story, given what we're seeing in terms of tensions between the US and China?
Well, for growth, I'm quite confident that for the time being, we will have a strong growth prospect, either in Europe or in France as a country as such. But I think for the short run, the most important thing is still the sanitary situation. The Delta variant, the level of vaccination in the country, the way we can address new medicine, these are, I think, still the main drivers for growth. And also the way public policies adjust. For example, in France, we've had a policy which President Macron called whatever it costs. Now we must get out of it. Not brutally. We must be targeting some firms or some sectors that are still fragile. We must also target some regions. We must be careful with that. But we must get back to normal. For the medium run, then the situation and the geopolitical situation is a main driver, and we must take great care about that. You're talking about EU-China, US-China tensions, but I would also mention Afghanistan.
So what is your take on Afghanistan? I mean, speaking of pulling out brutally, that's certainly what the optics are of that move. Did the U.S., you think, communicate well enough with its European allies? Are you concerned about Afghan allies still in the country?
Well, to make a long story short, I think this war in Afghanistan was obviously lost before President Biden came into office. I also think that the decisions were in the pipe before he came into office. After that, obviously, some communication problems have happened, as you may say, and maybe more than communication problems.
Well, but these problems could strand tens of thousands of our Afghan allies there. And isn't President Biden responsible for that? I mean, even if Donald Trump made an agreement with the Taliban, Biden has reversed a lot of Trump decisions since he's come to the White House.
I'm not going to comment too much on internal U.S. politics. That's not my job for today. I can have my thoughts, but that's not my purpose. What I can say is that it's absolutely necessary first to reaffirm the credibility of the U.S. support towards its allies, whether it is in Europe or in Asia. And second, that it's absolutely necessary also to rebuild trust between the allies. I think this is doable. Yeah. And that's what we must do now.
All right, rebuilding trust. Thank you so much for your time. Pierre Moscovici, the French Court of Audit president, talking to us from MEDEF. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin. We're also joined by Tom Keene, co-anchor of Bloomberg Surveillance. And Tom, I know you're looking at Jackson Hole with, bated anticipation, and you have a great chart looking at jobless claims as well.
Back up here is jobs. I'll be honest, I'm not sure which is more important, Jackson Hole and the Powell speech, or Francine, the labor report of August of September 3rd, and part of that report is the picture of claims. It is a gorgeous chart. It is the single best, most mathematical trend chart I have. I'm sure there's one out there I don't know about, but on a moving average, those are called Kleinman moving averages. Fancy logarithmic math. All you got to know, Francine, is it's an elegant chart and it tapers.
It does taper, Tom. When you look at jobs, I mean, how much, does seasonality affect actually the summer months? And I know it's very heavily skewed, especially in the UK, especially, because of the reopening, people are going out. I don't know whether the pandemic changes that or not.
My tie's a disaster. Come on, Matt Miller, say something about my tie. My tie is a disaster.
You're looking dapper, Tom,
today.
As always.
There we go.
Gorgiosity.
Okay, it's close. What's important here is to answer Michael McKee. Michael McKee is expert on seasonality, and Francine is very much in there and adjusted, but never perfect. And I'll be honest, for 18 years, I go like this. I go, Mike, tell us about seasonality. That's my approach to it, to be honest. The answer is claims are weekly, they're really good data, and it's a really constructive trend for Chairman Powell.
How important, Tom, is monetary policy right now when we're looking at spending bills that are $1 to $4 to $10 trillion? Yeah. I mean, isn't it all about fiscal?
It is. It is a change policy. Matt, I remember a number of decades ago in my youth, before the first gray hair, where Alan Greenspan would not speak about fiscal. Alan Greenspan would not speak about the dollar. Times have changed. And it's all rolled into one, and the answer is none of what we're living in August to this Jackson Hole is in the textbooks. It's all original.
It is original. Tom Keene, so are you. Co-anchor there of Bloomberg Surveillance, of course, on shortly. Fix that bow tie, Tom, and then we'll talk. Now look at what else we're watching today. I know, Matt, you're looking, of course, at this EU-U.S. travel, because we'll find out today whether U.S. citizens... Yeah, saying, can I come over to Europe?
I've gotten so many texts last night after the news broke that the EU is going to reconsider a travel ban on U.S. citizens. As you know, I'm having a wedding October 1st. I've already had to move the date 3 times. And obviously, I'm expecting many friends and family from the U.S. So personally, it's important. But I think the overriding issue here is that we see a complete reversal of the beginning of the summer. At the beginning of the summer, the U.S. was doing so well in terms of vaccinations, and I was incredibly frustrated with the sloth of Europe. Now, Europe is clean and safe and wonderful, and the U.S. is just a disaster. I mean, there are more than 500 new cases per 100,000. Deaths are on the rise, and you've got the vaccination stuck at 50% because people are worried about, 5G nanobots, and they're using like horse tranquilizers instead, and it's really unbelievable.
Yeah, what's interesting is that we were trying to figure out the rules, and I have to say in the UK, you feel like these rules sometimes, Matt, are a little bit murky because they put, for example, countries on a red list that shouldn't be if you just look at the metrics. But I think the EU has specific rules. So if there's a trend, for example, of more than 4% of those tested of the virus coming into Europe are positive, then they'll do something about it. So we don't know exactly what the figure is at the moment, but we'll know later today.
My thing is this: if you're fully vaccinated and you have a negative test, does it matter where you're coming from? I mean, isn't that okay? Aren't the odds good that you're not going to be a super spreader?
I wish I had the answer to that. Again, if it's more than 5% in those cases that test positive, then maybe they want to change their mind. That's probably the story of the day when it comes to things that we're watching later. More Bloomberg Surveillance is ahead. I'll be joining Tom and Lisa. This is Bloomberg.